When you buy a real estate property like HDB or private property, you will most likely get a loan from either HDB or a bank as the amount is huge and you will pay back over time with interest back to the lender. So when interest rate is low, you pay less interest, and when interest rate is high like now, you pay more and more. Seldom people will pay full amount in one shot unless you are from a particular country. For Reit-wise, it is similar as they are highly leveraged on borrowings to do acquisition and asset enhancement. So for Reit, there are more avenues for the Reit manager to source for funds rather than the typical HDB or private residential property buyer. So what kind of borrowings, loans, or debt does a Reit have? Trap number 1, debt. The three main funding sources for Reit will be secured bank loans, unsecured bank loans, and medium-term notes. And how you should look at these three sources as a Reit investor to look up and make a sense out of the debt trap. For secured bank loans, the bank needs collateral in order to lend you money, and in case anything happens, they are able to take your assets back. For unsecured bank loans, the banks will lend you money typically without any collateral, and this is normally based on your credit worthiness. So for Reit-wise, you can see that reputable Reit such as CICT will have quite substantial percentage of unsecured bank loans. As you know, they are CICT for a reason and strongly back up like Heavenly King, where this allows them to borrow funds quite easily. However, such reputable institutions are also being trusted that they will be able to repay their loans on time. So, in the event of default, you know the backlash will already be serious. For secured bank loans, the percentage will try to be kept as minimal as possible for REITs, as assets are required to be pledged as collateral by the banks. All forms of borrowing are largely tied with interest rate, which means when interest rate rises, cost of borrowing will also rise. If the REIT is not reputable enough, then banks will not lend to the REIT, or banks will require the REIT to pledge collaterals for fear of the REIT not being able to pay, or worse, a default. That's where you may see a drop in percentage of unsecured bank loans and rise in secured loans, or a drop in both secured and unsecured bank loans, but high in medium-term notes, which will be a red flag to investors. Why is that so? Medium-term notes basically are similar to bonds where they have maturity range between 5 to 10 years, and they can be continuously be sold by one or more dealers to investors over time, which is unlike bonds that are issued once. Medium-term notes are also not typically traded in the exchange. Therefore, medium-term notes offers investors a solution where their goals are beyond short-term bonds and yet not having to commit long-term. So, for CICT case, we can see that for the next 3 years from 2023 to 2025, bulk of these medium-term notes will be maturing, hence explaining the highest percentage out of the three funding sources, which is 48%. Bearing the interest rate right now, will we see more medium-term notes being issued out again to investors? Probably not, as investors will expect a higher interest rate of return if future medium-term notes are being reissued. If interest rate starts to fall, the future medium-term notes could also be recalled back to revise the interest, as such medium-term notes normally have callable option which will benefit the REIT. So, if the interest continues to hit high, we may see a reduction in maturing medium-term notes and also unsecured loans, as banks will not lend the money freely without collateral. Hence, there could be an increase in secured loan moving forward for REITs in general. Another two fund sources will be private placement and right issues, where investors get shares of the REITs for discounted share price. Private placement are mainly for institutional investors, and rights issue will be for the retailers, investors like you and I out there. Actually, both of private placement and right issues are not good in a way because the REIT are looking for funds from the investors. However, private placement is a better option if institutional investors are willing to fund the REIT. That means they see value somewhere in the REIT. If not private placement, then right issues will be out for the retail investors. As investor, we also need to know what the funds will be used for, whether it is for acquisition, asset enhancement, or worse, to fund a debt. Anyway, private placement and rush issue will normally cause a dilution in share earnings. Trap number 2, management. Management is one of the utmost important factors in any organization. And this is not exclusive for REIT as well, as we could see the structure of Singapore REITs. From here, we could see that there are 2 managers, which is the REIT manager and property manager respectively. The REIT manager, as named, is particularly important in setting up and managing the REIT through strategic acquisition and divestment of properties to ensure that there is growth for the REIT. As such, the REIT manager is compensated with management fee, which includes a base fee and performance fee. Hence, the performance of REIT is heavily tied with the REIT manager. If the REIT performs well, the REIT manager will naturally be compensated well. More importantly, investors will get to enjoy higher distribution and potential capital gains from performing REIT. The REIT manager also has the authority to appoint a property manager to manage the real estate properties under the REIT. The role of property manager will include maximizing the tenancy mix, occupancy rate, rental income, running events and promotions, and general upkeep of the properties. Hence, the property manager and REIT manager work together hand in hand, and as an investor, you do not wish to have either one, or worse, both of them to be fucked up. Non-performing REIT will also have dividends cut, or getting money from investors through frequent right issues that will cause loss of confidence in the REIT, and resulting share price to drop. Years back, where there is a saga of Sabana Industrial REIT manager being overpaid despite the REIT performing badly. The units holder of the REIT had a petition for the removal of the REIT, which had no fruition. Until recently, there is news again from one of Sabana REIT major shareholder requisition an EGM to be held, and one of the resolution will be to remove the REIT manager. This had caused another major shareholder of Sabana REIT filing an injunction to restrain the EGM from holding. And how will this evolve from here? With that, I'd like to end off. This is not any financial advice to buy or sell shares. And if you like this video, hit the like and subscribe button. Adios.